Hi there, my name is Jamal Khan. I'm a senior tax partner at Churchill Tax. Today I'm talking about one of my favorite topics, which is company share buyback. I've seen a few scenarios of this recently. I've been instructed on a few occasions, so I thought I'll do a quick webinar on this and just to give my audience some knowledge of this is a possibility and can have many benefits. Let me share my slides. Here we are. So this is a little bit about us, in terms of what we do. We're tax specialists. We operate throughout the UK and overseas. We help people with tax planning, companies and groups with tax planning and tax investigations, tax disputes and tribunal matters. So what is company share buyback? So it's essentially company buys its own shares from an outgoing or exiting shareholder. There are a series of rules to be followed. Exiting shareholder must substantially reduce their share capital in the company. So it has to be, you can't reduce it by say 10%, but you have to significantly reduce. In most cases, we see the exiting shareholder completely giving up their shares. The company must have been trading and they must have for a number of years, and also the shares must have been held for a certain period of time. What are the benefits? So this is typically there to resolve shareholder disputes where one party wants to exit the business. This could be a husband and wife getting a divorce who own the company equally, and the husband or wife wants to exit the business so they can be paid out. Partner disputes, old age, retirement, somebody wants to retire and they have some money sitting in the company, and this can be used as a favorable method to get them paid. Because if you do it properly, if it's done correctly, then you can get favorable capital gains tax treatment of 10%, which is the business asset disposal relief. Although it's from April 25, this tax treatment will go up a little bit to 14%, but it's still very favorable compared to the typical capital gains tax rates, or if they were to take the money out of the company and pay dividend tax at 42%. So if there's a clean break, you pay minimal amount of tax. But there are certain rules that you need to follow. Okay, process for this is you get advance clearance from HMRC. Careful planning required. Okay, HMRC have 30 days to accept the clearance, but in our experience, we haven't had any rejections. They normally respond within 1 or 2 weeks. So once the clearance is here, then the actual process starts. The start of the buyback, a lot of board resolutions, contracts. It's a lengthy process. You have to keep HMRC, you have to update HMRC, and also once it's done, you have to update Companies House. A series of documents to be done, to be uploaded on Companies House. This process can take a good 3 to 4 months, because we have to allow for things going wrong as well. But once done properly, it can be very, very beneficial. I have helped clients with this. And they've saved significant amount. I had one client that came to me, they were going to take some money out of a company just to pay off the exiting shareholder, and that would have been treated as dividend, and they would have paid somewhere around 42% in tax, because it would have gone into hundreds of thousands of pounds. I had another client who came to me who wanted to take a property out of the company. And I said, no, don't do that. That's very expensive because you have all sorts of capital gains tax, income tax issues, and stamp duty issues with that. This is a very good, neat way of doing taking money out and paying the exiting shareholder. Okay, so this is me. If you have any questions, it's got my background. If you have any questions, please do get in touch, and I would love to be able to help you out. Thank you. Bye.